All right, let's get started here. Welcome back for many of you. I'm excited to walk through the quarterly update that we've been doing for quite some time now. And there has been a change since the last time that we got on the phone together and walked through the forecast itself, knowing that we have had some more upside economic information in the economy. It's really exciting knowing that the vaccine has been rolled out. We're going to talk all about that moving through the next 45 minutes or so. So as always, big thank you, Tom Morrison, for putting this together, scheduling it. It's always really great to have that connection and looking at what's going on in the economy, the markets that we operate in, with the report that you've received lately, and what has changed. What has changed since the last time that we got together? You're going to see some of that in today's discussion. Feel free to chime in with questions as we move through today's conversation or presentation. Utilize that chat box that is in the Ring Central form in that little box. So when we look at the overall outlook, and that some of these charts are familiar, some may be new to you since last quarter, but COVID is in the rearview mirror at this point in time. There has been a resurgence we've seen in, let's say, India and other European areas, but when it comes down to it, a lot of the emotion that's tied to COVID and tied to the decisions, not only from a business but also from a personal standpoint, are coming off of your optimism with these vaccine rollouts, with the amount of doses being delivered, with the amount of people being vaccinated, which we can see clearly on this particular chart here. 153 million, at least one dose, 116 million in the US itself fully vaccinated. That creates more optimism. That's going to lead the individual to go out and the business leader and purchase, let's say, new equipment and new activity from your particular industry. So there is a lot of good news happening coming from the overall vaccine doses and the people being vaccinated when it comes down to business investment, which your businesses are heavily tied to, is the B2B industry side of things. Now, I'm not going to say that everything is sunshine and rainbows in the particular markets that you operate in. There is definitely pockets of opportunity and pockets of weakness that we'll talk about today, to say, okay, let's focus on one particular industry that's thriving right now versus focusing your marketing efforts away from an industry that's not going to see that growth. That's the whole point of these types of conversations and these reports, is to deliver you economic information that at the end of the day is going to save you more money than what you're spending. Is what markets should I be finding the growth in versus the markets that aren't going to be seeing that type of optimism. Now, this is probably if you've been following ITR for quite some time, this is a familiar chart to you in most cases. We have updated it though. The white vertical bars there that you're seeing is every time there was a president that aligned up with the Senate, so red or blue. When they were in alignment with red, in alignment with blue, that's when you see that white vertical line there. You've probably in the past have seen the chart of without those vertical lines and just have seen the white GDP line that you're seeing moving horizontally overlaid on top of whether or not there was a president as red or blue. That's the colorful charts that you're seeing there, is whether or not there was a president that was red or blue. The white bars are when they were in alignment with the Senate. We ran the numbers on this, similar to when we ran the numbers on the overall theme of red or blue in the economy. There was, when it really came down to it, there wasn't really a huge convincing factor to say, you know what, when there is sole alignment in red, sole alignment in blue from the Senate and the presidency, the economy performs in a certain way. The numbers were slightly higher on the bluer side, on the Democratic, but it wasn't enough to really move the needle or convince us to say that we're going to rely on Capitol Hill to drive our decision of where the economy is going to go as we move into the next 4 years. We're 19 plus trillion dollars with the latest data. We're a larger economy than what's going on Capitol Hill. Not to say that we don't look at legislation and so on and so forth, but when we break down the numbers that what we're seeing here, and Warren Buffett said it best: red or blue, you can still make green. So knowing that the movement of that white horizontal line, which is in this case real GDP, and the performance, the largest metric we can track in the US economy, is nearing that record high activity again. And we're going to see that record high activity by the later parts of this year, which is really encouraging, really good news, meaning from your business's standpoint, what do I need to be doing to prep for the rise and the recovery? And I'm sure that the numbers and the charts that I'll be showing you shortly are going to perk your ears up. It's going to be really exciting to see that you're out of, and I know that we're on a somewhat of a political chart here, but out of the red into that recovery phase, that expansionary phase. We're starting to see those numbers develop in your particular institution. Another perhaps familiar chart that we look at, and it's gotten even worse as of lately, is observing what's going on in the overall stock market performance against what's happening in businesses. Logically, overall, businesses should perform in alignment. Actually, I would say vice versa. The stock market should be performing in alignment with what's going on in businesses, in their profitability. If business asset prices are going up, so should the stock market. Profitability is going up, the stock asset value should go up as well, and vice versa. When we start to see that gap widen, which all the way to the right, and I'll use my cursor here so to kind of show you which areas which years I'm talking to, is you can kind of see a little bit of an alligator mouth all the way to the right, where it has been widening for some time. Why is the stock market going up, up, up? That blue line, the S&P 500. So we're making a general assumption that the S&P 500 is a general gauge for the stock market relative to domestic profitability in the green. Flashback 20 years ago, we saw a similar deviation happen in the late 90s, early 2000s recession that we went through. And what happened was there was an over asset value in, especially at least the technology market, whereas corporate profitability wasn't showing that prosperity. Lo and behold, early 2000s took hold, the recession took hold, and the realignment, the somewhat correction happened that drove that green line to match up better with the drop in the blue line. I'm not saying that we forecast the stock market because here at ITR we don't do that. We don't forecast the stock market because we believe it's somewhat of an independent metric of what's actually going on in the economy. But what we're looking at this particular chart here is, in order for this to logically make sense, it would have to come from a drop or a rise or somewhere in the middle, meet in the middle of the blue and the green lines. So I'm not giving you an exact projection as we head into the future, but just keep that in the back of your head. Really track that data, because it is something that each and every day we're taking a deep look at, and it's somewhat of concern to us. So let's talk about the macroeconomy, GDP. We've actually recently revised our outlook for GDP through the next 3 years. The dark blue that you're observing on this chart is historical data. The teal bars are the forecast. Not a huge change that we've made since, let's say, the last time that we spoke over the phone, but it is a mild upgrade. We've seen a good rebound with the stimulus happening, with the more optimism because of the vaccines, stimulating a lot of extra activity and catalysts to propel us into a better year as we move through 2021 and 2022. And again, not to say that there aren't certain areas of the verticals that you serve that aren't doing so well right now. I mean, you look at the aircraft market, which is recovering right now. It's recently rebounded, but it's still not doing so hot. And we've seen a lot lately with the Colonial Pipeline disruptions that could completely wreak havoc on your market, either in a good or a bad way. How do you take advantage of the economic information to be able to price yourself correctly, to find a good supply chain on that side of things? And when I talk about verticals, it's good to know, okay, what areas of the economy are doing well, what areas of the economy aren't doing well, and let's focus my marketing and my sales team toward those areas that are doing well and away from the areas that are doing negative or not doing so hot. In this case, when we look at the retail sector, and I know that some of these industries you don't operate in, some you do, but it's always nice to kind of just get a good picture to paint of where's the growth happening. In this case, the bottom half of this chart is the positive industry. That's where things are really thriving right now relative to the negative side of things on the top half of this chart. Clothing stores, the brick and mortars, the restaurants are all seeing that negative behavior. Even if we start to see restaurants pick back up, I guess my concern is that there will be an over inventory. So if you develop new material, there's no demand for that new material if there's already existing inventory out there from all of these other restaurants that are shutting down shop and liquidating and giving up their equipment, going to other stores. Likewise, that can happen to the other industries that we're seeing on this chart here. Is if there's already areas of or equipment across the board, why not just buy used instead of new, which could limit the ability for your business to perform in that certain way. Whereas on the other end of the spectrum there, you got the Home Depot stores, you got the grocery stores, the online retailers, all really thriving right now. So from, again, that marketing and sales aspect, the opportunities are going to come from that lower half of this chart here compared to the top half of that chart. Housing is also a good thing to look at. I won't spend a whole lot of time on this because I know that you're not heavily involved in the housing market, but what really tells us the direction of where the housing market's going to go in the future is our leading indicator for housing. And that is that green line that's been shifted into the future by 1 year. Mortgage rates. Mortgage rates inverted. All the way to the right, you can see the 0 on the top of this chart, the 9 on the bottom, meaning this is inverted. So when that green line is actually visually rising, it indicates that mortgage rates are falling. And when it's dropping, visually dropping, it means that mortgage rates are rising. When mortgage rates are low, it's more favorable, more incentivized to go out and buy a new home. And that's why we see the housing market in the blue line, which is really hard to see as of lately, just because the correlation is so well. So I know it's somewhat of a challenge to identify the blue between the green, but that's honestly, I love seeing that because it means that there is such a great relationship, such a great correlation between the two, indicating that pretty much for the next 9 months or so, we're going to see higher housing market activity, and that's probably not a shock to you. I'm not gonna say that you're not aware of what's going on in the housing market, because certainly that's something that everyone out there is currently talking about. So knowing that housing prices are going up, the cost of building is going up, are you making pricing changes to accommodate that, as well as focusing on a regional standpoint? We've probably discussed this in a similar but also a different chart previously, a few quarters ago, but this is now looking at permit trends. So I decided to change it up. I believe last time I talked to you, I looked at migration patterns and where people were moving to and out of. What this is looking at is permit trends. It's where are the permits happening, the growth that's happening in each particular state. From a regional dynamic, where should I be focusing my efforts toward? The states that are growing 26%, 28%, 17%, let's say in the more western states, versus the Northeast, which isn't really seeing a whole lot of, I guess, general prosperity with the negative pattern in New Jersey and the negative 1.1% in Rhode Island. So knowing that, should I be holding accountable my sales accountant, my account executive that's focusing in the Northwest or the Midwest or the Southeast or the South or the Northeast to the same accountability of hitting their quota, depending on how the economy is performing? You could have someone in the Northwest, kicking their feet up on the desk, doing essentially very little work to hit their 10% quota, versus the Midwest individual that is, working their 12-hour days because they can't find the opportunity. So prorating or assuming or utilizing this chart here will go a long way to maximize your bottom line. And from, cash is cheap right now. From a liquidity standpoint, we're looking at where are interest rates going. Interest rates follow mortgage rates. And what we're looking at here is the projection of each regional Federal Reserve chairman at the time, or the regional Federal Reserve presidents in each particular region from 2021, 2022, and 2023, and even beyond that. So to see the general flatness across the board up until the longer run, which still is very on the lower side of things, is interesting to observe, knowing that cash will be cheap, borrowing will be cheap. If you're looking to do it, I would say do it now, because the economy is only going to improve as we head through the next year. I'll skip over that particular chart just for time's sake, but what's telling us that we're back on our feet again, that we've went through this V-shape recovery, this V-shape rebound? The blue line that you're seeing is the industrial economy, which in fact MTI moves extremely well with. So knowing the leading indicators and identifying the leading indicators for MTI is great. One of the great correlated market trends that we look at ITR for MTI, for the industrial market, is the utilization capacity rate. Leads by 6 months. So if businesses in the manufacturing industry is becoming more busy, the utilization is going from 60% utilization to 70% to 80%. That means that there's going to be more demand for those products, and that's going to be more demand for new investment. So the rise in that green line indicates that 6 months later, that's what you're going to feel. And what you'll notice is all the way to the right, the green line has been shifted into the future by 2 quarters, by 6 months. It's now above zero. It's now generally rising, which is great news for not only the macroeconomy on the manufacturing side and the industrial sector, but for your businesses that are tied to the industrial sector. When we look at also your overall industry itself, this isn't looking at a vertical market that you serve. This isn't looking at a specific, leading indicator. This particular trend is observing how you perform against your competitors. I know that there's a large aggregation, a large sum of what's going on in the overall market what we're looking at here is U.S. primary metals production. The green line is looking at the historical data, as well as the gray line. The diamonds and the circles, that's our forecast. unfortunately, there's good news and bad news here. The latest data is down 15.2%, all the way to the right. If you can follow my cursor that's circling around that number there. Good news is that we're on the rebound. We've seen that V-shaped recovery that you hear a lot in the media from, the Wall Street Journal. You turn on the news, you hear a lot about V-shape, K-shape, U-shape, W-shape. All of that is kind of put out in the media. In this case, we are looking at that V-shape. And good news is that we're in that recovery. That negative 4.9% is really exciting. It's telling us that we're back on our feet again. The leading indicators that your business moves with is saying, you know what, let me go out and hire that new individual. Let me go out and invest in that new capital equipment at this low, interest rate level, because things are on the mend. This year, even into next year, will be better. You can visually see it with our forecast at the moment, as well as our other leading indicator for the PMI, the ITR, the U.S. Purchasing Managers Index, which leads the economy by 11 months, has been shifted to the right into the future, that green line, by almost a year relative to the forecast for overall manufacturing. Correlation's perfect, is great. And it tells us things are back on the mend again. I guess shifting gears a little bit here toward more of the supply chain side is looking at, how much does it cost to do business from a manufacturing cost standpoint in the US, all the way to the left there. That is the basis point at 100. So everything over 100 means it's more expensive to do business there. Everything under 100 it's cheaper. And this actually caught my eye when I looked at this chart to notice that China is pretty much almost at the same level, a little bit cheaper than the US, but a lot of people think, oh, China's, way cheaper. When you break it down to the numbers and the cost of doing manufacturing, China's, the cost of logistics and getting those goods from China to the US it takes some time. It costs money compared to fabricating and manufacturing those products in the US, rather than having to spend the money to transport them. So this is a great chart that kind of goes to show what's going on across the board of how expensive is it in each particular country. Should I be looking at, Mexico, which is 86, Malaysia, which is 83. Those are the cheap places to run now, relative to China, which is 95 to 97, pretty close to the US of the cost of manufacturing. Again, for the sake of time, I'll skip over this chart, but please utilize this. What it's breaking down is every single industry, or not every single industry, but a lot of industries, and whether or not they are growing or contracting year over year. So this 12-12 rate of change is telling us, are they up, are they down? The negative, the positive. Aircraft parts, I already discussed that, down almost 20%, where we're seeing some growth in the high-tech industry. Can we be shifting our marketing and sales efforts toward those particular industries to maximize our margins, which also ties into what we're looking at here, pricing. What type of pricing changes are you making as of lately? Is it once a year? Is it Jan 1 every year? Is it once a quarter? 2 times every year? Is it a case-by-case basis? Are we looking at, contract-by-contract cycle? Understanding that the pricing inflation that we're seeing can help you gain margin if you are identifying what's going on in the overall market. Now, the next chart that you'll see is more on the metal side of things and the commodity side of things that will allow you to observe the inflation that's happening and to say, okay, I need to be raising my prices. If I'm not raising my prices right now, my margins are being eaten. And that's reflective in this particular chart where the orange line, which is producer prices, are growing at almost 6% all the way to the right. Consumer prices, meaning the prices that you're passing on to your client, your customer, the kind of inflation that you, me, every day going out shopping are feeling, is at 4.2%. That 1.7% difference means that's what you're eating in your costs. And it's even worse on the commodity side. We look at these colorful charts here. You can see all the way to the right that copper, aluminum, zinc, steel, all up above 25%. Copper especially, 75.8%. That is insane. That is extremely high. So if you aren't making, focusing on pricing and getting together, with your colleagues to discuss, what do we need to be doing differently, your margins are going to be eaten. But focusing on those pricing changes itself. So let's get into your market itself. I know that I'm hoping for maybe the next 5-10 minutes to talk through the forecast itself and look at what the industries are doing for your particular industry before we open it up for Q&A. At the moment, we have upward revised your overall forecast, but this is a screenshot from your report that looks at each particular industry, especially from, I would say, from page number 8 down. So page 6 and 7 are largely macroeconomic outlooks. You move very well with 8 through 14. So to see the outlook and the difference between the growth expectation for the construction, automotive, oil and gas, medical, aircraft industry, computers and electronics, you have 2021, 2022, 2023. What I'm seeing on this chart is that the aircraft industry will see a better year this year because it's rebounding off of a very, very low 2020. So 2021, yes, it will be up 17%, but that's because it's hopping off of a extremely, extremely low 2020. Whereas the medical industry is poised for growth year over year for at least the next 3 years. We're seeing the rebound because of the vaccines, because of people going back to hospitals and offices. That's contributing to growth on that side of things. Utilize this chart. Look at where the growth is on this chart for particular industries such as heavy duty truck production. E-commerce is gigantic right now. It's a huge industry to be in because I like to call it the Amazon effect. Why not get into the heavy truck market? Because everyone knows that we got to find the drivers, we got to find the people, but that means you have more leverage on the pricing side of things. So for your forecast, we have revised your forecast on the upward side of things, given our updated outlook because of inflation. The data that we're looking at for overall MTI is measured in dollars. Given the inflationary aspects that we have been faced with, especially on the commodity side of things, the oil, the gas, the steel, aluminum, even on the housing sector, has led us to drive our forecast into a more upward direction. It's not aggressively changed. It's more just of a tweak upward. But no, on the left-hand side of the scale, positive things are coming your way for the next couple of years, 2 years. But it won't match what you went through in, I would say, 2019. You can follow my cursor there. In this case, it's what type of conversation should we be having from a forecasting standpoint. Okay, how do I need to be preparing for this rise that we're seeing in the orange bars there, while also knowing that this rise won't surpass this 2019 peak that we saw. And during this decline that your overall industry has felt, did you downsize? Did you get rid of people? Did you do certain things during this descent that would limit you from hitting the rise that we're expecting as we move into the next few years? What really put a smile on my face and perked my ears up that I mentioned earlier too is from the report itself. What really makes me happy is on the bottom half of this chart, not the top half. The bottom half is that one little blue chart there on the bottom right, because overall the average sales data has been in this recession for almost the entirety of the last 12 quarters. That's what you're seeing in the red, the contraction rates. So although, I mean, unfortunately, we're still in that 18.3% contraction, it's in the blue now. It's not in the red anymore, which is really, really good news. And the forecast itself is actually even more exciting to look at, is that we're going to go into the blue for another quarter. We're actually already in, 2Q21. And then we're going to see growth in the green moving into the rest of this year, into early 2022, even all the way into for year-over-year growth into the later parts of early 2023 and mid 2023 before we start to see a little bit of headway. So know that, like I mentioned earlier, we're in the rear view mirror. COVID's in the rearview mirror, your recession's in the rearview mirror. Things are going to be looking good as we head through the future. All right. Construction machinery, new order trends. Know that, I mean, if you can get away with kind of, I would say, finagling your way in the construction market because of what's going on with lumber prices, because of what's going on with everything else, if you can get away with leveraging yourself to push up those prices, why not do it? But in general, we do expect that overall construction new order trends will continue to go up, very similar trajectory of your overall association, where it's not going to hit those record high levels, but it will continue to rise. And it's knowing that pricing is going to go up, inflation is going to go up, business is going to go up. How do I price myself in a certain way? We have revised overall the automotive industry, and there are certainly different pockets going on right now in automotive, where new construction isn't doing as well as existing. I wouldn't say construction. New production isn't doing as well as existing production. Repairs, that particular market is doing better than going out and buying a completely new car. You fold in the lack of the chip shortage that we're seeing right now. That's going to definitely be a hindrance on what we're seeing in overall vehicle production. You can't find the chip, can't build the car. And we're seeing that a lot as of lately. We cannot find the chip itself. You fold in the fact that we have this huge the plant that burned down, I believe it was Louisiana, with the chemical plastic plant. A lot of plastics go into chips. A lot of people think it's just copper, but there's a lot of plastics, a lot of resin that goes into chips. That's also going to hurt this particular industry, the auto industry. But the higher demand for electric vehicles will also be the more of an upside risk. You can see it in, in the text here. So observing this in this report and moving your eggs into certain baskets will give you that advantage that your competitor isn't aware of at the moment. Heavy duty truck production, good industry to be in. We're going to see some strong rise coming from here. The e-commerce effect, everything going on there with that aspect of things is going to contribute to that strong rise. Again, for the sake of time, I'm just going to kind of skip through some of these things, but oil and gas right now with the shutdown that's happened lately, but it's recently, as of recently, opened back up, going to propel us into a good position. Knowing that the next year or two will not mimic the levels that you felt, let's say in 2019 and 2020, but they will eventually surpass that level with our forecast that we're seeing. A lot of the upward pricing that we're seeing, what that usually does is that incentivizes investment. When prices go up, which I mean, at least at the gas station that I stopped at today, I completely saw higher prices going on, really contributing to higher profit margins. Higher profitability ultimately leads to higher investment, higher products that you are involved in, and that's what we're going to observe in the oil industry itself. Kind of switching gears here to the medical side of things is medical equipment and supplies construction or production. Now, medical is a very interesting topic to discuss because it depends on where you're focused in medical. Are you voluntary medical products? Are you involuntary, emergency type of products that you serve? It's all very different depending on the industry that you serve. Firsthand, I know that involuntary is seeing a really good rebound because everyone's now more safe and getting back to work again. I'm sorry, on the voluntary side of things. You have to go through a certain surgery, but it can wait a few months. You're going to wait that few months because of COVID. And that's all piling up into where we are today at the moment. And the resulting factor of that is a huge increase in overall medical. And when we look at the data itself, if you can follow my mouse again, that's what's going to contribute to that overall rise. I believe this is the last indicator to talk about before we go into the Q&A, but it's computer electronics. The main topic of conversation I do want to discuss about computer electronics right now is actually there's two. One, higher demand for working remotely is contributing to the higher prices. When you look at the data point itself, at least on the left-hand side, I guess I wouldn't even focus on the right-hand side. The left-hand side, rise. There is a whole lot of opportunity coming from this market that's not reflected. And we look at, I can flip back to the previous charts. Maybe not oil and gas, but when we look at computer electronics, are you focusing more your efforts into this particular industry? Because our outlook for computer electronics is phenomenal. From a pricing standpoint, from an activity standpoint, and now the lack of chips is also driving prices up even more. So know that this is a great industry to be in at the moment. So I will turn it over now. I know I hoped to get a little bit more time for Q&A, but I will turn it over to Q&A. Feel free to chime in the chat box and ask any questions that you have at the moment. So the one question that came in so far is, can you get a copy of the slide deck? Yes, you will get a PDF copy of this slide deck afterwards, so you'll be able to use this. In fact, I have a lot of clients that utilize this slide deck, especially on the pricing side of things. What they'll do is they'll PDF that, you know, the one inflationary side, show it to their suppliers and say, this is why I'm making this price hike or this price change. The reason I'm doing this is not because I'm trying to, for lack of a better word, screw you over. It's because I'm doing it because that's what the market prices are suggesting, and I'm trying to maintain my margins. So please utilize this deck to your advantage. Another question is looking at, let me read this quickly. All of your data suggests a Nike swoosh recovery versus a V recovery. I don't see business fully recovering until 2024. Yeah. I mean, it's industry by industry case too. We can't expect every single market to behave in the same pattern. The metal industry too is, I was talking to a client yesterday actually, and it was very interesting to hear, you know what, their sales are in this extreme rebound, but their margins aren't in that rebound. So we have to be tracking not only the sales or the revenue or the orders, we have to be tracking every single different aspect of the business to say, you know, what do you care about most? Do you care more about your top line sales, or do we care about our margin on the bottom line? All right, let's see. An employment question. All right. So the next question is looking at productivity being hampered by lack of U.S. workers. What do you see happening in the near future with employment numbers? It's definitely a little bit different from a Trump to a Biden era, given the agenda of both of those presidents, to say, you know, one's more protective of people coming in, one is more liberal on individuals coming in. So it really does depend on that. But at the end of the day, even with today's circumstances, we can't find the people. We cannot find the people to fill the jobs right now. Meaning, what does that mean for you? You have to raise compensation to find the workers. That's one option. The second option is, okay, well, I'm going to replace with robots or technology. So you hear complaints a lot in the media about businesses replacing their human labor with technology and robots, but they have no choice. That they can't find the people. I mean, last week, a business leader I was conversing with said that they hired 4 individuals. They wanted 4 new workers. They hired those 4 new workers. Has said, you start on Monday. One of them came in. Only one of them showed up to the job. Because people are still collecting their unemployment. The incentives are all out of place because of COVID, because of the stimulus that's been a result of COVID. So it's interesting to see, once we get out of this post-COVID world, how the incentives are going to change. Because right now the incentives are, let's stay at home. Apologize for the silence. I'm just trying to read the next questions. Next question: Are we competing with the government social programs for employees? If so, how do you see that changing, and what the impact on wage rates and inflation? Well, from my personal standpoint, when we look at government programs, it's definitely, I think a lot more inefficient than the efficiency of the natural, private businesses. um, so for, employees, you have that safe haven of working for the government. Wages are lower, but government also makes a lot more money on the negotiation side uh, of things itself. So I don't know the exact answer to that. I will tell you that. When it comes down to the wage and inflation, the wage rate, I've gotten a lot of these questions in the past of what happens when we put the federal rate to $15 an hour. Is, what, all of a sudden you're raising your rate to the same exact percentage rate than what you're increasing that individual worker to, and everything, all boats rise with the tide. So from a wage standpoint, when you see the minimum wage rise from let's say $12 to $15, what about those people that are making $15 an hour getting angry at people that they're now working with that are on a lower caliber, I would say, that are making the same amount of money? They're going to ask for their wage increase, and then your boss is going to say, you know what, I now need to preserve my margins. I need to raise my prices. And then your landlord is saying, okay, well, I need to raise my pricing on my rent. So the actual purchasing power hasn't changed at all. Purchasing power is still the same when you raise wages across the board. All right. So what we'll do, because I know that we are running over time, is the trends talk. The lingering questions. What I'll do is I'll put together a podcast style show. It's free to you, and I will answer all the lingering questions in a trends talk. It could be 5 minutes, 10 minutes, 15 minutes, 20 minutes, and I will be able to disperse that to you to answer all the lingering questions. But I appreciate everyone's time today, and I look forward to talking soon, knowing that things are, in the more positive trajectory. So brace for that, prepare for that, know that good things are coming your way. Feel free to email me with any other questions, but again, I have access to the kind of the lingering questions, and I will provide you with that podcast. All right, everyone, appreciate the time and take care.